That's a very good topic these days. Very, it's a topic I think we should touch base for sure. To let projects know like how exactly it works over there. So I mean, it's over to you, Tony.
Well, Abdul, you can ask questions during Q&A part.
Okay. I'll save it. I'll save it at that time. All right.
Yes.
Cool, guys.
Don't drop it right here. And yeah, I see that we are live, which is really cool. So welcome everyone in this Wednesday evening, whatever country you are in right now. I really appreciate that you spend your time joining us today for this workshop. In the Zoom, we have startups from In Mind who reserved their space in advance. Great job, guys. And in YouTube live stream, I see we have already 12 people who joined. Hi, guys. That is cool. And throughout the workshop, Tony will share not only amazing knowledge and insights, but also he promised to give some special extra materials and templates that would be super useful. So keep an eye in the chat in Zoom for those founders who are here inside. And those who are in YouTube, keep an eye on the live chat on the platform or In Mind Telegram channel, where we will forward Tony's links. And yeah, I already said a couple of times the name's Tony, but for those who do not know him yet, guys, I'm super excited to have Tony here today with us because he's very, very special guy. He is the president of Moonbound Consulting. Sorry, I always mess up with the names. And moreover, he did some amazing growth hacks in his own founder journey. He launched a project that reached incredible numbers in token sales and token holders just within 3 weeks. And moreover, he spent, there is, when someone wants to become an expert in certain field, there is some rule that you need to spend 10,000 of hours in studying and researching this particular aspect or segment. Tony spent at least 4,000 of hours working specifically on tokenomics aspects. And I think more than 10,000 of hours studying and researching all the aspects about token performance, liquidity, analysis of the market price, and so on and so forth. So he's really an expert without blah, blah, and bullshit in this sector. So Tony, great having you today. And thanks a lot for agreeing to give this workshop.
Yeah, thank you very much for having me. So, I'll go through the presentation I have prepared for you all, but really what I'm going to be trying to do is really break this stuff down in simple and visual detail, because I realize that it's very confusing for people to understand. But if you can understand what factors actually influence the value of your token, it'll make you a far better founder. And the sad reality of it is that's what people look at as a primary gauge of whether or not the project is successful. It really sucks. Because if your token price is falling, they say the project isn't successful, but wait a minute, the team might be building, right? And so what I'm going to be showing you today are really some things that you can take away, that you can apply right away to be able to figure out how best you can position yourself, whether it's before the launch, during the launch, and after the launch, to make sure that you're doing so in a sustainable manner, okay? So I'm going to be showing you this stuff as I kick this off. Let me go to the presentation I have prepared here. So basically, let me just go ahead and go into my full screen mode. There we go. It should be all right now. Okay. So the name of this presentation is important. It's Mastering Your Tokenomics and Your Project Growth. That's what we all want to do. We don't want to just launch and then go nowhere. We want to launch, grow in price, grow in our holder count, and that's really the name of the game. That's what people look at when they say, is this project actually working? Is this project actually successful? And just to give you a little background on myself, I have 20 years of actual operations experience, technical, marketing, sales. I'm a full stack engineer. I've launched and grown my project to 70,000 holders, over a $200 million market cap in 3 weeks. And I'll share gains that I've learned along the way too. I don't recommend anybody grow that quickly, because if you have a problem, it also grows that quickly. And that's what I found out as well. So I'll share this stuff openly. And I've learned from all these mistakes. And I actually have just running my own Web3 project. I have 3,500 plus hours of actually running a project, building the community, growing the community, doing all the marketing, doing all the work with the token economy, managing the whole development team. We had a 72 smart contract infrastructure we built as well, where I served as a CEO, CTO, and co-founder at various points. So all this stuff is shared from a place of actually having done this before, which makes it pretty unique in the space. All right. And so my goal today, like I mentioned, is to help you really understand what are the key factors that influence the price of your token, but more importantly, to help you understand those factors better than 99% of the founders in the market. Because if you can do that, that's going to make you a much better founder. That's going to enable you to have the confidence when you're actually live with your token price and trying to grow that. And maybe because you don't understand basic fundamentals, it's impossible to grow the token price just through a simple thing such as setting up the liquidity in the wrong way. And that's why we're going to be reviewing this stuff in detail. And that's also why I'm going to start with DEX liquidity and how the DEX actually works, okay? Because when I talk later on about inflation and tokens coming into the market and where that value strips out of, it strips out of the liquidity pool, right? And that also influences the price in a negative manner. So that's what we're going to be talking about as we build on this presentation. It builds on itself. You're going to learn exactly how DEX liquidity works. You're going to learn the complete process of how a token goes from funded to launched on the decentralized exchange, alongside things that you need to be cautious of. In addition, I'm going to show you live examples of sustainability, because that's also important. We don't want to give out a whole bunch of tokens and have people selling them. That will create a lot of pressure in that liquidity pool. That will drop that price, right? And I'm the master of doing that stuff. I've actually had a ton of selling pressure, a ton of rewards I've given out. And I'll say it's over $10 million that I've given out rewards, and I've suffered the pains of doing just that. So I'm going to share with you openly the things I've seen that worked, things I've seen that haven't worked, all right? Also, utility versus speculative volume. A lot of people think it's actually the tokenomics, the mathematics behind all this to drive the price. Well, wait a minute. A project can do an announcement, you'll see the price go up by 50%. If it's a low cap, it might go up 3,000% or something crazy like that. You see it all the time, right? Like, how does that actually happen? Well, that's looking back at the liquidity pool, but furthermore, understanding that almost everybody in this whole market, all of us that hold ETH, all of us that hold Bitcoin, I'm not holding that Bitcoin to use it. I'm holding it because I want it to go up, right? And understanding that that is the core truth of most people in the market is key to understanding what will actually influence the value of your token price. It will be actual speculative volume, all right? And I hate to say it, but it's the truth, not how much people are using it, okay? So how much people will use it is important. You need to have that, but it's not the key factor. It's speculative volume, all right? And the last thing is we'll do a Q&A at the end of this, but also throughout this presentation, what I will do as well is I will actually ask you some questions. That way I can kind of get your input and you're not just sitting here watching me talk, all right? So let me just ask a question of someone in the audience. Go ahead and unmute yourself. And I want you to tell me, what is a decentralized exchange and why do we need one? Anybody, go ahead, you could speak up.
Well,
Ruslan.
I can start. Yeah, DEX is software, yeah, or a platform where basically two people across the world can trade with each other. So they don't have central counterparty to settle their trades. That's the basic idea.
Let me just share it with you. You don't need two people. You only need one person, okay? It uses mathematics to facilitate the exchange of value. So if I'm going to sell tokens, I put tokens into the liquidity pool and I take ETH out. If I'm going to buy tokens, I put tokens into liquidity. Sorry, I put ETH into liquidity pool and I take tokens out. There's no two parties in that exchange. It's all within the liquidity pool. And that's why it's called an automated market maker. The centralized exchange has that order book, right? And that's why you see the market makers in there. As someone else was asking earlier, Abdul, is also you need the market maker to facilitate those exchanges between those parties. So that way there is liquidity in the market, okay? So anyway, that's what we're going to be talking about here is really the DEX. It enables that automated trading 24/7, okay? It basically uses that liquidity pool, and I'll show you what that actually is and what a liquidity pool looks like to facilitate that trade, okay? And it uses math to determine the price when swaps actually occur. And I'll give you an example. Let's say I have $100,000 in the liquidity pool and somebody wants to buy $10,000 worth of tokens. They're going to take $10,000 worth of tokens out. They're going to put $10,000 in. Now we're going to have $110,000 essentially in that pool, right? And we have less tokens. Therefore, the price goes up. Tokens are scarce, more scarce. The value in the pool is higher. That's backing the token. It raises the price. Okay. And so that's a really simple way for you to kind of understand how this stuff is working behind the scenes. That's the swap, right? Swapping tokens for ETH either way. Okay. And it's also going to hold assets for the trading pair. Okay. So that's essentially what it is. The trading pair is essentially where you see, you know, BUSD / the token symbol, or you see ETH / the token symbol. That's the trading pair. And there could be multiple liquidity pools for the trading pair on the token as well. Now, it's also important to recognize that most decentralized exchanges will use a fork of Uniswap v2 or Uniswap v3. And there are some differences between those two, okay? So I'm going to give you a real quick example. Actually, I'm going to paste an article here in the chat. The Inmind team wouldn't mind pulling that out. But really, when we think about Uniswap v3 and we think about liquidity, all right, like I mentioned, let's say, for example, I'm going to pull up this as well. All right, this is our liquidity pool. All right, we have $100,000 worth of USDC and we have 100,000 tokens. The price per token is $1 each. Really simple to understand. That's sitting there on the decentralized exchange. Okay. Now, when it comes to the differences between the V2 and the V3, Uniswap V2 applies that liquidity across the entire range of the price. Okay. And so what that means is if we don't have a whole lot of liquidity in the market, we have something like this, okay, it adds volatility, okay? It's more volatile because if we have 100 grand applied across an entire price range and somebody buys $10,000, it's going to disrupt that much more so, and I'll explain why later on. But if we have $100,000 applied towards a concentrated price range and somebody buys that, it's not going to disrupt it as much, and that's really the core difference. We're not going to go through much math today, but that article is something that I encourage you to read because you're probably going to want to be on the V3 pool when you go ahead and launch your token. Okay. And I know V4, I think, is coming out as well. But this is a really important article for you to read, and you can see the visuals with it. You can see how it's actually changing where that liquidity is being applied. Okay. That's important for you to learn about. All right. But we're not going to go through a ton of mathematics and stuff like that today because your eyes will gloss over. Instead, we're going to go through some other concepts here that will help you to be able to understand this as well, such as the differences between two liquidity pools. Okay, I'm going to share this with you, and we're going to talk about volatility. All right. So let's say, for example, I have $10,000, all right, in this pool right here, and it's $1 million market cap project. What that means is I'm building my pool with $10,000 worth of ETH, and I have 10 million tokens. 1% of the supply. Those tokens are valued at $10,000. Very simply, $10,000 worth of ETH, $10,000 worth of the token. Okay. The market cap is $1 million. All right. The market cap is essentially, you know, if we look at the value in the pool, $10,000, that's 1% of the fully diluted market cap. Okay. A very small amount. That's what we'll call a low float tokenomics, where you have a very thin amount of liquidity on that decentralized exchange. And I'll show you why that's a problem in a little bit here. Let's look at another pool though, as an example. Let's say we have $100,000 worth of ETH on the pool, okay? And we also have $100,000 worth of the token. That's 10% of the actual token supply. Now look at our liquidity right here. You can see the difference between the two. Now, what I'll share with you is, let's say somebody were to go in and sell $10,000 worth of the token, and we only have $10,000 here. That would drain the entire liquidity pool and send the whole price spiraling down to essentially zero, right? And if somebody bought $10,000, that would disrupt that price or that amount of value quite a bit. And that would raise the price up significantly. It might even double in price, essentially, or be close to it. Because we only had $10,000 here and we're bringing in $10,000 more, we're disrupting that pool and raising the value significantly, okay? And that's where you see that volatility set in, okay? Now, in this example here, we have $10,000 sell that goes into $100,000 worth of value in that pool. That's only 10% of what's there. So it won't disrupt the price as much, right? And that's really what I want to show you as a first point here, is when it comes to setting up these liquidity pools in the decentralized exchange, you can see with just how much value you put in the pool, how you can impact your volatility. right? And that's really, really important because the last thing you want is a ton of volatility to the upside and a ton of volatility to the downside. And I'll share with you why, okay? So when our project is live, we want people to, let's say we want somebody to buy in for $20,000. Wow, that's a great buy. That looks amazing. We love it. Well, people who have $20,000 are not going to buy into a very thin liquidity pool, pump up the whole price and let everyone else sell off on top of them. They're not stupid. Okay. And that's exactly why you don't want to set up for a ton of volatility. You want to set up opportunities for the investors that you want to bring in, right? Because it's a speculative market. It's all about bringing in the investors into the token. As I explained earlier, that's what drives the price. So if you have an opportunity for them to get in and not have that huge green candle come up, that's going to enable better capital efficiency for them. And they're going to be more likely to want to go in and buy that token. Okay. And that's what all the big whales out in the market, this is the people want whales in their project to hold the floor and people who believe in what they're doing. Right. And that's why when whales move Bitcoin and stuff, we get afraid, right? Because whales are moving, right? And the same thing is true with your project. You look at your holders list and you'll see that most of your largest holders will be those whales that have significant capital. They didn't get it by not being smart, most of them. Okay, some got lucky. But that's why it's so important to set things up like this, so that way you have adequate liquidity in there, but not too much. And I'll explain why that's also important in just a little bit as well. Okay, so now I'm going to show you something really cool here. So the question then becomes, Tony, I get it. We want a liquidity pool built, but where the hell is it? Where is the liquidity pool? How do I find it? How do I get there? Okay, so I'm going to show you where it's actually at. This is a project I'm pulling up here. I'm going to refresh this so we get the latest information. And what I want you to see here is you can see on Dex Tools, this project, you can see has about $185,000 worth of liquidity. Okay, remember what I told you before? The liquidity is both the tokens and the ETH that's inside the pool. So what we should expect to find here is half of this value will be in ETH and half of this value will be in tokens. Okay, let's look at that. So I'm going to click into Etherscan right here, and I'm going to go to the holder account or the holders list, which is going to show me the Uniswap V2 pool. You can see it right here. I'm going to click into this, right? It's bringing me right in. You can see it's a contract here. That's the contract that holds liquidity. Now I'm going to go here to the actual holder. I'm going to look at what they actually hold. Look, this liquidity pool has $91,000 essentially worth of ETH inside of it. Okay, so what's important to realize here is we have $91,000 that's backing a market cap of about 800,000. Okay, this is actually really healthy. I like to see this about 10% of the fully diluted market cap. So when you see something like this, you can see that the project has actually built its fundamentals correctly. Now, what if I would have looked at this and saw only $10,000 worth of liquidity? Okay, now you would have looked at this market cap and seen that only $10,000 was backing $800,000 worth of value. So now if we think later on, if somebody were to sell $10,000 worth of tokens, what would happen to the price? Crush it right to zero. It would zero the price. It would really destroy that, right? However, in this scenario here, if someone were to sell $10,000, maybe somebody wants to get out or whatever, it'll drop the price, but it won't bring it all the way to zero. It'll have a little bit of an impact to it, probably around 10 to 15%, but definitely not almost all the way to zero, right? Through stripping all that liquidity away. This is the value that's backing the token. And so many people don't get this point, and they don't get this point, and it makes them either terrible investors or terrible founders. So if you're not looking at your liquidity pool and you're not trying to figure out how to best manage this, that's going to mean that you don't even understand what's really backing the value of your token. I'm going to show you an example of one that has a big failure to it. All right. And so I'm going to look at this one. I'm going to show you the holder count. Okay. I'm going to show you this. Look at how many millions of dollars these tokens are worth. Okay. There's no money in the liquidity pool. Nobody has any money. It's all air money. It's a Sam Bankman-Fried approach. That's what it is here. Okay. So nobody has any value they can get from the pool. These tokens, although they're worth millions of dollars, nobody can get millions of dollars. It's completely worthless. Okay. And if we think about the investors that we want to bring into our project that are buying in, maybe through fundraising, and we set things up like this, so later on when their tokens are released, there's no money there for them to even get. Won't that be a problem? Won't that be a terrible thing to go through? And I know Nelly knows projects that went through this exact same scenario because they didn't realize that it's the liquidity pool that needs to remain healthy, at least for the time being, until something else changes in this market, so that people later on, when they do get the tokens, or maybe when you have the tokens that release for your marketing, your development, your treasury, whatever it is, you actually have some form of extractable value. Because if there's no value backing it in those pools, or even on the centralized exchange to your market making activity or buyers buying that, there's nothing to get. You're going to go nowhere. Okay, so that's one thing I wanted to show you there that's extremely important. The next thing here is like I mentioned, the Uniswap V2 versus V3, this is a really important thing for you to understand is, like I mentioned, instead of applying across the whole range of price, which is what we did with V2, now let's say I'm able to take that 90,000 I showed you in there and concentrate it across a specific price range. Now, when somebody buys in, it's not, let's say they buy in with $20,000. It's not going to affect the price as much as it would, because it's concentrated across a very specific range. And I know that's difficult to understand, and that's why I linked the article so you can go through that and you can read through that. But I highly encourage you to understand how that works, because when you set up your pools, that's going to be really important to realize. All right. And I'm going to share one other thing with you that also links back to this. Okay. So let's say, for example, I'm going to pull up this template here. And by the way, like I mentioned, this template, I wouldn't mind posting a link in YouTube, you can get for free. You can download it right now. Okay. So you can get it for free. And let me just show you this. All right. Let's say this project is raising $3 million on the launch pad. They're going to have 70% that goes liquidity. Okay. That means their pool will have $2.1 million in it. Now I'm going to share with you why this could be such a challenge. Okay. So let's say the project is live. It builds its pool with $2 million. All right. Now, when the project goes to market and bring in new buyers, look how much weight it's going to have to lift from new buying activity to raise the price. It's going to be really difficult to lift that, right? But we also don't want to have such a little amount that it's actually really terrible and it's very volatile, like I mentioned. So what we really want to do is be reasonable with these pools. That's why I recommend you work with someone who knows how to do this stuff. So that way, when you set up your pool, let's say instead of 2 million, it becomes 500,000. And we do some math, we see that the volatility is good. It still works. Well, now if we bring in 100 grand worth of positive buying pressure, we have a chance of changing that pool and bringing that price up on the launch, which is what we want to see with a token price launch, what we want to see on the launch, right? Nobody wants to see a launch where the price goes down. That's terrible, especially when it goes down below the pre-sale price. People think it's dead. They don't buy it. No new people come in. You'll see a bunch of FUD in your community. That'll create a ton of problems for you. And this thick liquidity on launch is a major problem for projects that don't know any better. They launch with all this LP. It's hard to bring in new buyers and move that price, so they go nowhere. And then people get all bored, basically, because the price isn't moving and the people that bought in pre-sale start selling, and then the price goes down. You see it time and time and time again, especially with these fair launch models on the launch pads. So I'm going to pause right here and ask, does anyone have a question before I go into sort of the next section?
Guys, in Zoom, don't hesitate to raise your hands and ask questions. I see Alex unmuted himself being first. Alex Mirkin, please start with introducing yourself shortly, just for Tony to understand what is your project about, and then go on with your question.
Hi, everyone. My name is Alexei. I'm in the UAE right now, and my project is called Blocksurance. We are providing or attempting to provide tokenized asset coverage for like force majeure, where people, basically the problem that we're trying to solve is that crypto is very volatile and people don't want to lose their money investing into crypto, so they are able to pay like a light premium for force majeure coverage in case some of these tokens go belly up in their portfolio. Our token specifically is more of it's a DAO governance token, and I wanted to kind of chime in onto the DAO governance tokens because they seem to have kind of a different style of release as of lately anyway. People seem to just airdrop a ton of them. I mean, there's some examples out there how Arbitrum is doing it, and want to see what your take is on kind of utility tokens versus governance tokens releases, and what your take is on that.
Yeah, I mean, here's the thing. So from a utility token standpoint, that's primarily a lot of what I work within, to be honest with you. The DAO models, they can be interesting, but I haven't seen tons of success in that model either. There's a lot of failed ones out that exist out there. The DAO models themselves, what I would say is that is going to primarily be based on governance, right? So you're going to want to make sure that you have some kind of a distribution schedule that makes sense, so people have, you know, reasonable amount to buy those or acquire those, and you don't have your governance is all lopsided, essentially, right? That is extremely important as I see it, especially as you're building like your initial community as well. So, but again, I'm not a huge fan of DAOs. I'm just being straight up and honest with you. I've seen some work, but the business model itself, I've also understood it to have a lot of risk. Like if there's a liability, then the whole DAO, whoever owns that, gets in trouble. I've seen that before. Actually, the DAO got sued in Europe. It actually happened. So, but again, I think when it comes to governance, that really revolves around voting. That really revolves around people having sort of like a proportional say in kind of what goes on within the project. That will require much different distribution than, let's say, a utility token, which is primarily what I work within and what I like to kind of work on, because that gets me excited. I like to build products. I like to think about revenue. I like to think about people buying the token and using it. The voting side of it, it just doesn't interest me that much. I'm just being fully transparent and honest with you. Because it just seems a little boring. I'm just being honest. I know it has value in it, but it doesn't have the excitement that I'm looking for when it comes to building a token, like a token model and working with the project. So hopefully I could answer. That's the best I could answer that for you. Thor, you got a question?
Yes, my name is Tor Peterson. My background is technical from the music and content industry, and we are working on what makes internet interesting, the content, licensing music to digital service providers and etc. So if the last question was boring, this is going to be much more boring, because we are extremely stable. We are not mathematical and built on scarcity. We are building on growth. Mm-hmm. That is, the more royalties running through our system, the stabler our system is, because we are just on par with the royalty tokens. Now, that is a challenge in itself in the tokenomics, because we are so stable, it's boring to invest in us, and we will grow that value over maybe 3, 5, and 10 years. And there is no way we can get someone interested in a DEX. So at the moment, we are building our own centralized with peer-to-peer over-the-counter exchange. Do you have any suggestion how such a stable environment could be interesting in a DEX environment?
Well, I think what you're building, I mean, not everything has to change in price. That's the thing. So although I just find the whole governance voting thing boring. I don't find your business model boring. I just find like, here's your tokens, you can vote on this. All right, great. That to me, it's not as interesting as, but what you shared is interesting to me. I'll just share why, okay? Because what you're building is I'm guessing the token represents your royalty share in what you're going to get, right? Is that what represents? What does it represent?
It represents a transaction fee from Spotify to, let's say, Björn Ulvaeus in ABBA. So everything we're building, the more exclusive content under our administration, the more will our 2 major tokens be worth, with the exception of the stablecoin, which is we call the creatives, which is used to pay for subscription.
Yeah, I'd have to look at that in much more detail than you're explaining it to me. That's why I would recommend I have a call link. Why don't you just book a call and we'll look at it, and then I can answer that question for you. I'll put the link in the chat, right, for you. In 1 second. Yeah, that's the best way to do it.
We have this link, and we will also share with everyone who is in Zoom. You will receive all the links duplicated in your inbox. Don't worry, guys.
Yes, because we want to keep the questions on the DEX, like specifically on that, but I get what you're asking. If you want to keep the price relatively stable, you don't want to change, you don't want a bunch of outside parties buying this, you can centralize all that within your own closed loop system. And then after that's kind of spun up and running, then deploy that into a DEX later on if you want to do that. There's nothing that says you have to put your token on a DEX to have people be able to buy it. That's all. The DEX is essentially a smart contract anyway, right? And so it's the math behind the smart contract that drives that. So you could very easily have a closed loop system. You can have your own math on how the exchange rate works when people buy, when they sell. You can have all that custom for yourself. Then later on, if you want to have it all tradable, public, or whatever, you can open that closed loop system up and deploy that on a DEX. And you could even take the value that you've built up inside that smart contract, use that for your initial liquidity too. So you could, I don't want to say it's easy to do it, but you could definitely figure out that whole transition. And I'm actually working with the project right now in that very thing, okay, that wants to start in a more closed loop manner instead of have a whole community that's all speculation when they're trying to spin up in the beginning. And that's the challenge I think you're trying to avoid with that, Thor, is you don't want the price to go all over the place in the beginning. You want to have some closed loop thing that you can control to be able to spin this up, to see things are working right. And then when the time in the market could even look better, then you can deploy later on into something more public, right?
Plus the security and the acceptance, if you like.
Yes.
We just got a grant of 200,000 euro from EU committee for setting up the fair music platform. So somebody believes in this.
Yeah. Yeah, I think, that's a huge area. I know several projects working in that space. So yeah, I think that's going to be a big area that we're going to see a lot of innovation in. But yeah, let's keep going, guys.
Okay.
We have limited time. Excellent question. Go ahead and book something if you want to review all that in detail. I'd love to look at that with you. All right, so let's talk about the launch process. All right, now this is something that a lot of founders don't understand and how this process actually takes place over a given time period. For example, we're raising this money through a launch pad or something public where people can buy the token. And there's a reason for that. I'll share that with you. Is if you want to have your liquidity pool, right here, it says $2.1 million. If you want to have that value in the pool, and we know we need that value because we don't want our token to be all volatile. Well, if you don't raise that from somewhere, then you have to provide it yourself. That comes out of your pocket. Okay. And the value in this approach, I'll just explain to you, is pretty much the fact that, let's say I wanted to raise $3 million on the public round, okay? And I have a $15 million market cap project, all right? So I'm going to be selling 20% of my supply to public, okay, for $3 million essentially. Now, when I'm doing that, I can take 70% of that value or whatever the percentage ends up being that we talk about for the volatility that we want to try and have reasonable. I can take that, and that's the free liquidity I get through the public raise to build the pool and launch on the DEX, if that makes sense. That's other people's money we're using to do that instead of having your own funding to provide that or having to go to some other liquidity provider, okay? So that's the value in doing that. But also, through the public launchpad, we're able to seed our initial holders and grow our community as well, and use the launchpad's marketing to our advantage too. Because let's just be honest, a lot of people that go on these launchpads go there for one project and they see another project, right? And that's more eyeballs on your actual project. That's marketing you can get access to. And I know some launchpads that even have a ticker across the top that show the projects that are on there, that are doing well, that are raising, whatever the case might be, even feature the project. There's also launch pads that are based on, let's say, gaming and these really specific niches. That way you could build a stronger community that actually has holders that are passionate about what your niche might even be. Like, for example, with Alex, you might have a whole niche that's focused on exactly what you want. Although it's not something I like to typically work in, right? That doesn't mean that's a bad thing. I'm just saying that's what might enable you to find the people that you want to reach that believe in what you're building, that want to back what you're actually building, right? So anyway, now the other part of this is we need to think about how are we actually going to raise some of this capital? And that's going to boil down to a lot of our marketing activities as well. So common rule is if you want to raise money on the launch pads, you need about 10 to 15 to 20% of capital to actually raise that. And I'll share with you why this is such a good thing to do. For example, let's say I want to raise $3 million. Well, as I just said, I would need between $300,000 and $600,000 worth of money for marketing, right, as I just explained, to sell this out. Now, if I used, let's say, $600,000 and I sold this whole thing out, keep in mind, 70% goes for DEX liquidity, 900,000 goes back to the project, okay? That's $900,000. That's already an ROI of $300,000 on top of that, right? And so you can see how using Launchpad to your advantage could not only enable you to sell out the initial public sale, to have your holders already growing, to have your liquidity raised, to actually get a potential ROI on your marketing activities, assuming you can market your project effectively, right? That's essentially how we raised and launched our entire project, was through a little bit of capital out of pocket to maximize it and get a return off of that. All right. I'm going to explain as time goes on, kind of this launch strategy as well. But the liquidity, like I mentioned, is raised on that launch pad. And sometimes, as I mentioned, the team will fund it themselves, but that's very expensive. All right. And after that point, after that liquidity is raised, then you see the token will be live on the decentralized exchange. That's when that actually happens. Okay. I'm going to show you a little process map that I built before this call to kind of show you the actual process of how this actually works. See if I can find it now. Just had it here. Maybe I closed up my window. 1 second. I'll pull it back up. All right. I'm almost there.
No worries.
Okay.
Your slides are so interactive that it's really cool to watch them.
So we're going to cover this. Okay. And so let's just think about this. As I just explained, we have the raise that's on the launch pad. Okay. We have a portion of the raise that will be for the DEX liquidity. Okay. That's going to make that token come live. All right. And we have the tokens at ETH that we raised to build the initial liquidity pool. Like I mentioned before, if that pool needs $100,000 worth of tokens, we need to have $100,000 worth of tokens to pair with the $100,000 worth of value and put on the decentralized exchange, which is where we will actually have the value for people to trade off of, right? And that's really where I mentioned the tokens and ETH are put on the decentralized exchange. And that's when trading gets enabled for people to buy. Has anyone heard about snipers and how they can destroy a whole project? Have you guys ever heard about that or seen that?
I heard about it.
All right.
I haven't really physically seen that work, but
okay. So a sniper bot, what it does is as soon as this liquidity is on the decentralized exchange, it right away buys a whole ton of the supply with very small buys with a ton of different wallets. And it buys all that up. And then what it does is it waits for other people to buy in and launch more of that volume to come in, and then it sells. And I've seen that destroy an entire project. Literally in minutes, year of work can be destroyed through just not knowing what snipers are about and how to mitigate them. Okay. So I'm going to share with you that I'm not going to share how to do it. I know how to do it, but I'm not going to share how. But I will have a checklist that I also provided in the chat here that you can get access to. All right. I'm going to put that in the Zoom chat. You guys grab that. Please post it on YouTube if you don't mind, team. In there is a checklist item to prevent for snipers from happening. And essentially how it works is there's a little bit of a timer that takes place. And once the liquidity is on the decentralized exchange, the timer starts off. And after the timer ends, then it'll blacklist all the wallets that bought. So if a sniper bot tries to buy all that up, it'll blacklist all that. So they'll buy in, they'll provide liquidity, it'll blacklist the wallets, and then they can't sell it. Okay. So you basically trap all that liquidity that they bought in with the sniper bot, and you kill all the bots. All right. My project, we crushed about 45 bots. Okay. So it could happen. And it usually does happen if snipers see that you're not watching for this stuff. But how you kind of navigate this is also while you're putting the liquidity live in the decentralized exchange, you have people inside of a voice chat in your community. And then after the token is tradable, that's when the sniper bot protection is off, you tell them it's okay to buy. Then people can buy in public and trade, and you've just killed all the potential for sniper bots to destroy your project. Okay. And that's a very safe way to kind of run this. All right. And that's the only way I know of right now to prevent that problem from happening. Okay. But after that decentralized exchange has the tokens on it, that's when that chart becomes live. That's the very first candle you'll see is when that liquidity is added and it's live and tradable on the decentralized exchange. That's when people can actually come in and buy it. Now, there's some problems that can exist. Okay. And I'll share this with you. So like we mentioned, when I showed you this chart, like right here, okay, this is kind of where they launched at, right? And now if this project had launched right here, let's say they sold out their entire pre-sale right here on the launch pad and they launched immediately. Here's the problem with that. If they went right from Launchpad right to DEX without having some kind of a gap, and let's say everybody who could have bought the token did, where's the new buyers and new liquidity coming from? It's not going to come in, right? And what we need to have when we're live on the DEX is all that new volume, all that new liquidity coming into the market to push our price up. So that way, if some people from the Launchpad were to sell, it absorbs some of that selling pressure, okay? And that's key. Because if the price goes down from the launch price, like if this were the reverse, you'd be like, wow, that project is terrible. If it went down right after that, nobody's buying that, right? Nobody's buying that. And so that's really why I put in this note right here, that what you want to really have after your Launchpad round is a 24 to 48 hour gap with heavy marketing. So remember what I told you is we have the initial investment we put in for our marketing to raise this, and we have an ROI in that investment. Well, this money you got back, you use that to create a ton of marketing and a ton of enthusiasm, a ton of energy for your project, because you need all that new volume to come in. You have to grow your community. You have to grow a base of new people who want to enter the project. And that's why it's such an important aspect of making sure you understand this process, because if you don't, and you don't bring any new people after your Launchpad, nobody else is coming in to buy, and it's going to be a problem. Right? If we have that gap and we have a plan for marketing, we have the ability to bring in those buyers and to have all that new liquidity enter the market. Okay. All right. So I'm going to go to the next thing right here as an example, kind of fundraise. This is a really simple thing that you can kind of take away is if our raise is, let's say, $2 million and our market cap is 10 million, we essentially have 20% that we're allocating to public, right? And so if our supply is $1 billion, then our tokens allocated to public is 200 million or 20%. You can see how that works. Okay. It's really simple how this stuff actually works. In this template that I've put together for you. All right. I do have like a little course in this that you can check out if you want to get that, but I also have a video with instructions that you can watch right here. And this will actually show you at a high level how to use this template and how to set up the initial baseline of this stuff. Okay. Which is important. All right. I'm going to talk more about that as time goes on. And we start talking about inflation, I'll break this down in more detail. All right. But like I mentioned, you can get absolutely destroyed with your project. You can spend years raising money, a year building something. And then finally you come live and you forget about sniper protection. Somebody buys your token up, they kill it, and then you're dead. And you can't relaunch. You can't relaunch because oftentimes you'll find your liquidity is locked as well. So now you're completely done for. And that's why it's such an important aspect. If you take just a few things away, I want you to take away so far the importance of making sure your DEX liquidity pool isn't too heavy or too thin. We don't want a lot of volatility and we don't want a little bit of volatility, right? That's important because when those new buyers come in, I just mentioned, we want them to be able to buy and disrupt and move the price up, okay? Versus not disrupt it at all and remain stagnant, okay? That's why it's so important. The next thing, as I mentioned, is marketing heavily between the funding close and the launch of the DEX. We need that volume to come in. We also need that new volume to counter the selling pressure that will come in, guaranteed, comes in every single time. We need to counter that with new buying pressure, new marketing, new liquidity entering our market. All right. The next thing is you want to also set in some controls. Okay. Like, for example, if I'm at my starting point of my token price, let's say it's cheap and some whale can come in and buy 5% of my supply at the base level. Well, look at what they have in their hands later on. They have your you-know-what's in their hand. And that's going to be a big problem later on. If your price grows and that whale holds 5% of your supply or whatever they bought up, they can dump and sell it. And that could destroy your whole project. It will create a huge red candle. I've seen that happen before as well. And that's why we can mitigate that with a max wallet amount. We can also mitigate that with a transaction size. Okay. So people can't buy more than 0.5% of the supply. They can't sell more than 0.5% of the supply. Okay. There's ways kind of around this, but most people won't do it. And it's also, as I've seen, a very safe way to kind of protect your project on launch. These are smart contract settings you're able to actually change in the functions when you run those. Okay. And you'll have to understand more about what that is when you're kind of getting towards your project launch. But as I mentioned, your budget for your public round should be about 10 to 20% of your actual amount you want to raise. And of course, you do not want to launch in a market like now. Okay. And there's a reason for that. And the last, I'll just show you why real quick. As we showed, our value right here is backing this, and it's in ETH, right? If the price of ETH falls down, it brings our token price down with it as well, because it's backed by that. Okay, if that makes sense. So if the price of ETH goes up, because we're in a bull market, it carries our price up and it helps us actually grow. And so that's why this is also so important to recognize that what you pair your token with, and that pair, if that changes in value, it's going to either bring it up or bring it down. And that's why if you look at like a 15-minute chart and you've seen like a sell come in, but a green candle arrived, well, maybe ETH or BNB or Matic, whatever you're linked to, that went up in price and it actually brought the price up, even though somebody sold a little bit. That's why you see that. And that's also why you see some projects will pair with a stable coin. The risk there, especially in this market, is if the stable coin pair fails, okay, like if USDC goes under, any tokens linked to it also go under and they're worth nothing, right? And that's the risk there. But also that project then doesn't have that volatility that takes place with ETH changing in price, or looking at BNB changing in price or Matic changing in price. It doesn't have that volatility because it's paired with a stable asset, okay? And that's kind of the value of that approach. So it could be good, but also understand, as Alex here is in the insurance industry, the failure that could set in that case could be detrimental to your project, okay? So now what I really want to do, because I have about 40 minutes left, is I'm going to go through and talk about sustainability, okay? So I feel like at this point in time, I shared with you a lot of ways in which the token price is going to be largely controlled through the liquidity, through decentralized exchange, through trading activity. And now is when I want to really talk about inflation, the allocations, the release, and why that can impact your token price, okay? With building on the backbone of what I just shared with you throughout this current presentation, all right? So I'm going to pull this up, but first, we want to talk to our reward systems, okay? This is a big problem that you see oftentimes out in the market with people as well, is the reward systems that they build, all right? They're not really based on real value creation within their actual project, okay? Like for example, you might see like Blur does a whole bunch of airdrops, and they just airdrop all these different wallets to seed all these users. Well, when those users are getting those tokens and they're selling, they sell into that liquidity pool. They sell into the centralized exchange. They're stripping money away from the market. And that's what they're doing. There's no way for the price to go anywhere but down generally when that's happening, okay? And that's why when reward systems take place, you want to ideally make something that's sustainable like this. And we talk about our incentives, right? So in this simple simulation I'm going to play out, right? We have our users and our growth. So right now we have about 2,000 users on our platform. Users are spending $50 each month, let's say, on our platform. All right. So we have 2,200 times 50 for the total amount of volume that's going to flow through our platform. Okay. Now, if we break off 20% of that for incentives, and we think that the users who are spending 110 grand worth of tokens are buying that from the liquidity pool to use it, they're putting value into the token, into the pool, they're propping that price up. And then what's being released out to the other holders is essentially only 20% of that value. So let's say they were to sell, let's say 80% of the 20% sold, it would still be a small fraction of all the revenue that we've collected and all the value that's been pumped into that pool to help prop up the price. Therefore, it would not cause a decrease in the price, essentially, right? And that's the way we want to be thinking when we're building our incentives and our reward systems, is when value is created, value can be given, but value can't be given when value is not created, okay? And the project should have a good share of that value that's being created as well to make sure that we mitigate that selling pressure risk. Okay, because let's say we lopsided this and we gave out 80% of it, and we distributed all that, and then those people sold. Well, that would be a ton more selling pressure out into us. Look at this right here. Is after just a few steps, we're at 123,000 right here of potential selling pressure. If I reverse this, this is 80, and then this is 20. You'll see how quickly that'll grow. And if those people are selling, they're going to literally be destroying the whole value of your project. Watch how fast this stuff will grow as our users grow, as we start scaling our platform up, as we start seeing selling pressure come in through people who are getting tokens that are actually selling. You'll see this really start to grow very quickly. And you could see that before this was much less than this. And now look at the difference between the two. You can see how they're very close right now, and that's not good. That's not good. We want people to be holding the token. We want people to be using the token. We don't want people to be selling it constantly. And that's what you see a lot of projects do, all these airdrops and all these distributions and try and give away the whole farm. They're not really building a good sustainable business model when they operate this way. Okay. So that's what I wanted to show you real quick. I'm going to change this before I forget. Okay. There we go. Oh, it should be 80 actually. Okay. This tool is called Machination. So it's a really cool way to kind of build out your economy in a simple way and kind of see how things are flowing through there. All right. Now, what I'm going to go to next is kind of looking at these vested allocations. Okay. So I just showed you how distributing tokens to people who will essentially want to sell can be negative towards that pool and destroy the value of our token. I'm also going to show you through this spreadsheet right here why inflation can be such a challenge and why these allocations can be such a challenge for many projects. For example, let's say we're raising money for a project and this private sale goes from 10% to 20%. So we're going to have a huge chunk of value that the investors will get later on. Okay, that could create a problem later on, because when we start distributing those tokens later on, and let's say those tokens later on start becoming more valuable, like right here, we could see at this market cap level, what we're releasing is worth $41,000. Well, if I change that just from 10% to 20%, I'm going to change it right here. Okay, actually, I can't change it. I'm going to change it manually. There we go. Now we should be able to look at this, see how it doubled in value that we're actually giving away, right? On a monthly basis, through just this one change alone, it doubled the selling pressure from these people when they actually start getting those tokens that then they can sell, right? And so also what we want to think about, actually, I'm going to go forward again. I'm going to show you another thing. Let's say our market cap goes up in value, okay? Let's say our market cap goes from 15 million all the way to 50 million, okay? Now look at the selling pressure of that one. So if we want to raise our price and we give away a ton of tokens that enter and flood the market, and we give away a lot more of those, look at what we're doing to ourselves. Look at how much more difficult it makes marketing and new buyers and new liquidity to enter the market. Look at the challenge that creates for you. And so this is what I want you to kind of take away from what I'm trying to show you is you want to look at your allocations. You also want to think about the future value of those allocations, because that's such a critical component to it. And that's why in this template that I've built, I've also added in these market cap levels here, okay? So in this template, what you're able to do is set up your initial market cap and then say, you know what, I want to see increments in $10 million. And now you can see right here, not only the market cap level, but the value of the allocations that you'll actually be distributing. So you can say, holy crap, our staking, or let's look at our growth incentives. You know what, our growth incentives, look at as we grow, those can be worth significantly more money. So we might want to think about how we're distributing those, because if those rewards are coming out into people's hands and they're just selling them, what will that do to our liquidity pool? How will that actually impact our token price? How will that impact our community? What will that actually do to us? Right? And furthermore, if we don't really have a whole lot of value in our liquidity pool, and we look at our development allocations, and let's say that's becoming released, and we look at it and say, well, do we actually have any money we can extract? And if we don't, then we end up in the situation like this, with where I showed you, where you have allocations that are worth money that nobody can get anything from. Like, look at this. The team has $1.6 million, but they don't. They have nothing. There's no value there, okay? And that's why this is such an important aspect, is for you to understand how liquidity, how the allocations work, the value of the tokens you're releasing, how those will impact that pool, what selling pressure might even exist in managing that inflation accordingly. And inflation is the next thing I'm going to cover here. So I'm going to show you a quick example. We're going to talk about inflation using this Battlemancer's, okay? And this is a great example of why you don't want to take someone else's pitch deck or tokenomics and copy it, okay? Because this is really a disaster. I'm going to share with you why. When this project starts out, look at the supply, 1 billion. Look at the circulating supply right here. This is called, let's just call it 50 million, okay? So in 3 years, you could see it play out. In 3 years, they're going to dump 20 times the initial amount of tokens into the market and expect that to actually not destroy the price of the token. Okay, so we think about that. If our government started printing 20 times more money over time, what would that do to the value of our money? It would really diminish it. It would deplete it. right? Just like any other market that exists, you can't flood the market with a bunch of tokens or a bunch of collectibles or anything and expect that value to actually increase. You have to manage that accordingly, right? You have to manage it accordingly. And this is another thing that a lot of projects get wrong, is they have thin liquidity on the DEX. What that means is there's a lot of volatility then. So it doesn't take much money to increase the price of the token. And then when they release the tokens into the market, the value is even higher, but there's no liquidity backing it. So when they sell, you have that volatility and they destroy the price. And so then what this project painted itself into is the better job it does to increase its price, the more valuable those tokens that inflate into the market are worth, the more buying pressure they have to come in to overcome that, and the more likely they are to get destroyed and come down. This really simple loop, if I know this is recorded, come back and listen to this and understand it. I'm going to explain it again. The inflation of the tokens coming into the market, if they're worth even more, and we have thin liquidity, so we can pump the price even more, like Sam Bankman-Fried did with all of his air tokens, right? That's what he did. He pumped the price of the tokens up, then he borrowed against it, essentially. Same exact thing. We're pumping the price of the tokens up. When they become released and we sell those, or anyone who gets those and sells them, if there's not enough liquidity in that pool to handle all that, it's going to destroy the whole price and bring the whole project to zero. If you understand how this works, this will open your eyes up to how to manage your inflation, right? And also open your eyes up to, hey, how much value are we really releasing out into the market when we're actually building out our allocations, right? Because if we're looking at something like this, and we're looking at the monthly value of what we're putting out into the market, we're looking at the annual value of what we're putting out into the market at given market cap levels, right? Then we understand that, hey, maybe potentially we're getting ourselves into a really dangerous situation with our inflation because of how fast we're dumping tokens out into the market, okay? And just through looking at this alone, I don't even need to look at anything else, and I can tell that this is going to be a failure. I don't need to even look at anything else because it's going to be near impossible to sustain a 20x increase over 3 years with inflation. And if the price goes up, which people want, to actually have this become successful, it's going to be near impossible to sustain it. Okay, just the facts. And that's why I also have in this template, this right here, this vesting schedule. So you're able to go in and type this stuff out and just simply change this value. Let's say we want this to be 24 months. Let's say we want this right here, to be 12 months, for example. We want to have this as a 48-month cliff, 12-month cliff, 48-month vesting. Now you can see how that actually impacted the Now look at this coming into the market right here. You could see at the first year, look at what we're doing in our increase of our supply. That's going to be dangerous potentially for the market to be able to sustain. What I showed you before with how I had it set up, right? Go to redo. See how that was a lot nicer? See how that was different? So now when you kind of look at those spikes and things like that, that can also mean that, hey, when this time is coming, that could be danger for your project. How do we visually smooth this out? How do we enable the tokens to release over a longer time frame in a smooth manner so we don't have these big spikes of releases? And especially if we see a spike, who's going to get them? Will they sell them, right? That's also important to realize and manage, because if they do sell them, the value comes out of the liquidity pool or it comes off the centralized exchange, right? So that's, hopefully I explained all that in a clear manner. I know it's kind of difficult to understand the inflation side, but that's why I just want to show you through a chart alone. See the difference? Look how much more this will increase from this over this time frame. This right here is a 5-year time frame. You can see how that works. This is 60 months, 5-year time frame. We start off in this level here, right? And it's maybe a little bit over, maybe about 40% of the supply circulating in the beginning, and we increase that slowly over time in a very nice and as smooth as possible manner. That's going to be much better and easier on the market to be able to sustain that. Okay. The other thing I'll share with you too, when it comes to your allocations, this is something a lot of projects get wrong too, is if they're going to have some allocations for development or marketing, sometimes there's not even enough money to even do anything with. And that's another problem. So the other thing I'll share with you is if you have tokens for development and marketing, and that's how you're going to get all of your funding for development and marketing is selling your own token, I want you to think again about your business model. Like, did you build a business model where all you have to do to get revenue is sell your token into the ground? Is that smart? Is that the only way we can make money is through selling tokens? And if that's the answer to the question, then that's probably going to be a challenge for you. So you need to think about how else your project, your company, really your business can make money outside of just selling the crap out of its own token. Because I'll just be honest with you, we have bear market cycles. And there's times when projects don't do well. All the projects in the market generally aren't doing well right now. They're all down for the large part, right, from their all-time high. It's rare to find one that's up. I don't even know about one that's up off the top of my head. So if we're in that scenario, and then now our marketing tokens and our development tokens start being released, think about how you'll be able to look at your own chart going down and stare at your community every day, telling them it'll be all right. And then meanwhile, you're going to sell into them for your development and your marketing. You think that's actually going to be possible? Are you going to be able to pull the trigger? Furthermore, I'll be able to find that it's you selling in literally a second through going through the blockchain scanner. Okay. So that's not just sharing with you. It's like that will not happen. So I want you to think about, if you don't have a business model, you have any way to make revenue right now outside of selling your own token or waiting till they unlock so you can sell them, think about the bear market scenario, because that will happen. The bear market scenario always happens in this market. It always happens. And when that time comes in, you don't want to have your project be dead. You want to ideally have some way to be able to still generate revenue or some way to still have a stockpile built up. So maybe when there was a bull market, things were looking great, you could sell off some of these tokens and keep those reserves, and you protected your downside risk across those years, all right? Because that's really, really important. That's why the bear market wipes out most projects. It's due to lack of funding, and their whole liquidity pool is usually decimated. They can't sell anything, and then they're dead, right? And that's a huge part of that, all right? We'll keep going here. All right, done with this. Okay, that's why I mentioned this point right here. You have to have a way to make fiat without selling your own token. You should have ways to do that. Some projects have had NFT collections they've released as part of that to help fund that and help weather those storms, but there's other ways that you could do it as well. And I've just shown you some examples in machinations, essentially. So now, one thing I want to talk about is if liquidity runs dry, where will the project get funds for development and marketing? Like I just showed you, if there's no value to extract, there's no value to be gotten. Just as I showed you in Polygon Scanner a couple times already, that token is worthless. Nobody's getting anything from it, okay? And then like I also mentioned, if a chunk of the supply becomes released, what's the value of it, and will those people be likely to sell? And I can tell you, if it's an investor, count on them selling 100% of the time, okay? Maybe they won't. I'm just gonna tell you straight up, count on them selling 100% of the time. Optimism is a great example. This week, they're releasing about $3 million worth of tokens into investors, I believe, that will probably be selling. And that's why the price has taken a little bit of a hit, down about 10% in the past week, I believe. And then also thinking about your incentives and who you're incentivizing. Are people actually helping us reach our goals or simply benefiting holders, or worse, sellers? An example of that might be maybe you have some kind of an affiliate or referral program where, let's say Tony brings in Alex, okay, and Alex uses some tokens on the platform. Well, then does Tony get a share of the tokens he's used as sort of a little icing on the cake for helping facilitate that and bring Alex into the ecosystem, right? So that's a good incentive, because what I just mentioned earlier, when value is created, value can be given, right? So if Tony brought in Alex, he created value through bringing in Alex, who was actually a customer or user of our platform. When Alex used the tokens, which creates value, some of those tokens get distributed to Tony as a little bit of a reward mechanic for him, right? And you can see that if Alex then bought those tokens from the decentralized exchange, from the liquidity pool, he also added value and helped prop up the price. So if Tony does sell all those tokens he just got, we still retain a large part of the value. And if we don't distribute all those tokens to Tony as an incentive, and the project holds the majority, then the project can control the selling pressure much more effectively, can it? Instead of just airdropping all these tokens and expecting people not to sell, we're giving out all these rewards and all these incentives that people just sell and destroy the whole pool in the project, okay? So that, if you get what I just said there, that simple way to be thinking is how you should think about the structure of how you're building your tokenomics. I'm not gonna go through all math with you and all this modeling with you, because you don't need a lot of that. What's gonna drive the price is speculative value. I'm gonna show you that in just a second. So also thinking about where the funding from the funding to run the project is coming from. Like I mentioned, selling tokens solely, no bueno. You should have some kind of way to bring in real value outside of just selling the crap out of your own token. And also from a fundraising mechanic as well. I know Nelly can advise on this much more than I can, but I know some projects are also selling equity, doing token side letters. And the reason for that is quite simple, as I'll show you right here, is if we take this value right here and we say, you know what, we're going to raise $1 million, and we have a $10 million market cap. Now we change this to 2 million. Well, look, now we've just sold 20% of our supply to private. And what I just showed you before is that increases the amount of value that later on will be released and could be sold into the liquidity pool and maybe hurt the project, right? Now, if we can get this value down, let's say to $500,000, because we're selling majority and we're raising most of this money through some form of equity or something like that, because we have a business that actually generates cash, like I just explained, it has a real business model behind it. Well, now we have the ability to minimize this private sale through the tokens we're giving out, maybe even use it as some form of a side letter so people can get kind of a bonus of tokens on top of it and have access to liquidity later on when the tokens release, okay? So I'm not going to explain a ton more on that, but I did want to show you briefly how just the fundraising mechanic you're using can get you into traps and problems as well. And that's something you definitely don't want to be in, because essentially you'll have the clowns are running the circus, right? Like if you let the people who are planning on selling on you later tell you how to fundraise and manage your project and your tokenomics, I want you to think about that for a second. Like the advice they're giving you, why are they giving you that advice? What are they planning on doing later, and how will that potentially impact your project? Okay. Now I'm going to show you why what I say here, I believe to be true when it comes to the actual, like what actually drives the value of your token. I'm going to show this is not people using it for utility. It's not. It's speculative volume, or speculative volume does it. I'm going to show you why. Right? Let's look at this. So we can see Filecoin here right now. If we look at our circulating market cap, it's $1.4 billion. Our fully diluted is $6.3 billion. Okay. Our trading volume, okay, it's up today, is almost $80 million in trading volume. Okay. And I'll tell you, a lot of this is fake volume from the market makers and the centralized exchange. Okay. So a lot of this is fake. But that being said, I'll bet not even $100,000 worth of the token has been used today to actually store files. I would bet. I would probably bet 10 grand on that. And the reason why I'm saying this is if you just think about what I just said, if you look at what's actually maybe driving the value of this market cap, this price, this volume, this buying and selling volume, that's what's driving the value of the price. It's not so much the use case of it, but it's people speculating on the future use case of the token that makes people want to buy the token because they think more people will want to buy it to use it later on. That's really what's driving the value of all these cryptocurrencies you see, whether it's ETH or Bitcoin or whatever. They're buying it because they think later on it will go up. I'm not buying, I don't hold all the ETH I hold. I don't hold all the Bitcoin I hold. So that way I can use it all later. I'm hoping it goes up. So when I retire in 20 something years, it's worth millions of dollars. I can sell it and I'm done. That's what I'm really holding that for. And I'm sure a lot of you are probably in that same boat, right? And we shouldn't think that it's all utility that is going to drive all the value of our token, because it's not. It's going to be the speculative volume off of this, the people buying it. And although if we have a great utility, we're going to have a lot of people excited about using it, right? That's amazing to have that happen. And it does happen when people buy the token to use it from the pool. That helps us. But largely, you'll find most of your volume is going to be through speculators. And I'm not saying that's a bad thing. I'm just saying it's the facts. All right. So
I hope guys from SEC are not watching this workshop right now, because it will destroy all the plans.
Yeah.
Yep.
And you know what? It's the truth though, right? Like it is really the truth behind it, right? Like it's not like anything I said today is against like SEC, but it's the truth in the whole market, right? Like we want people to buy and use our token, right? But it's not truthfully what people buy it for in the current state, right? And so I think it's important to realize that if you cannot bring in new people through like new buyers through like your marketing or activity and things like that, your price will go nowhere. It's just the simple facts, right? And you will fail. You will fail. It's not people buying it to use it that's going to drive this price primarily, from what I've seen. And all the facts in the market, like you look at all the volume in the market, says that actually. So it's like, I hate to say it, but it's true. When I thought about it, I used to try and position, oh, it's all got to be about the utility and all this. Then when I thought about it, I'm like, wait, it's not the utility, because no matter how much utility I built, people still speculated and sold the project if it was bear market, right? They don't buy because it's not bull market, right? That's what's doing it. That's what's doing it. It's liquidity, right? And people buying or selling. And the last thing a couple last things I'll share with you is, your community is going to be extremely important, because when it comes to people buying, ideally to be part of the project, to buy into what you're building, to buy into the future of what you're building, right? That's going to enable you to kind of increase that holder count. And that's what also people will look at from a KPI standpoint of whether or not the project is successful. For example, if I see my holder count going down, that means people are selling. That's bad, right? If I see my holder count going up, that means more people are likely buying. That's good. So your holder count is also going to influence a lot of this as well. It's really important for you to realize that that is also the facts. And furthermore, a roadmap is also extremely important too, because as our project plays out, if we're releasing exciting features and new initiatives and things that actually drive growth, that's going to be exciting things we can talk about. Like I saw HBAR just maybe a month ago, it went up like 20%, which is huge for HBAR because of a news announcement they had, right? And it went up 20% because of that announcement. Well, that's a huge market cap project. HBAR did not go up because more people are using it. It went up due to speculative value of that. And that speculative value was linked to that roadmap and with the initiatives and what they were building out and what they're actually deploying into their project, right? And so understanding that is also key. You don't want to have all the toothpaste out of the tube on day one and have nothing to come out after, let's say the next 6 months. That's going to get boring. You need to have things rolling out and plan for that. That way you can keep people interested and keep them interested in what you're actually building. Okay. So that's really, really important. So last things I want you to keep in mind before we take some questions for the last 15 minutes is don't rush. There's no need to rush. This market is not going anywhere anytime soon, in my opinion. It's time. It's good to take your time. It's good to take your time learning like you're attending today, to spend the time that's necessary to understand our space, to understand what's really backing, in this case, the value of your token, how a decentralized exchange works, how liquidity works. If you understand all this stuff, you understand the value of your token. That's like 99% of the battle, because let's just be honest, any of us who hold the token that's going into the toilet gets upset, wants to get rid of it, doesn't believe in the project. It's just what happens. So those holders that you will have expect the same exact thing. In times of bear market, if you've done a good job of actually building up from whatever you launch from, then you can still kind of hang your hat on, hey, we're actually up from our launch price. Although the bear market's hitting us, we're still going, we're still building. And if you have a sustainable business model, you still have some money that maybe you've made too to be able to sustain that in the bear market. And that's why I'm sharing this stuff with you, is you don't want to be the project that lasted a year, the bear market hit, the pool's empty, there's nothing to sell. And then finally the investor tokens unlock. And then they're like, this sucks. We have nothing of extractable value here. This is terrible. That's not what we want. And Nelly, again, will tell you so many projects that she knows that had that happen to them. And that's why it happens, is they don't understand the simple principles I shared with you all today. Okay. And the last thing is, if you have a question, don't be afraid to seek out help. I mean, this stuff is really important. This will make or break your whole project. Okay. It will make or break your whole project. I hate to say it, but a lot of the success of your project will hinge on your price, your community, how you can build people into that, how you can keep them engaged, how you can keep them retained, how you can keep them interested in, let's say, showing how what you're building is going to be valuable later on. So maybe they look at the price and say, you know what, I'm happy it's down because I can get more. That's really a good mentality to get people into if what you're building is ethical and you have capital and you're going to continue. It's unethical to get people excited and have nothing to deliver to them. And then later on, you're selling on them through your marketing, your development, you're taking all that money. And then now you destroyed things and you ruined all the holders, basically whatever the investment they were holding, right? Not good. Okay. So I'm going to share with you again, I'm going to put in, I have the checklist in here I put in. So that link right there, definitely get the checklist. If you're a founder, 175 items that you can check. Okay. I'm going to show you what this is. This is not just across tokenomics. This is across your marketing, your community, your development, your website, your operations, your roadmap, your pitch deck, your white paper, your legal and compliance, your outsourcing, even how to save money in the space as well. So there's 175 different items. So I want you to click on this link, download the PDF and have this right now, because this is something that's basically I just thought about this and I put all these items in that I would want to know before I launched my project. If I had to do it all over again, these different categories, what would I want to know? How do I do this? For example, you all on the call today, if you don't even have your ideal customer profile mapped out, that's a big problem. If you don't know their pain points, that's a big problem, right? That's a huge problem. You don't know your strategic partners, how you're going to go ahead and build out distribution. That's a big problem. right? Like all this stuff is such a big problem if you don't have it, and you don't even have to think about it. You can just simply load up the checklist, go through these items. Some of these you might ignore, some of these you might disagree with. Great. At least you got your mind going and you have opportunities to maybe correct some of these things. And furthermore, if you're not following me already, follow me on LinkedIn. I'm going to drop my LinkedIn profile in here as well. There it is. So you can hit me up on LinkedIn. If you wouldn't mind putting that into the YouTube stream too, that would be great. I post content. I don't sell on LinkedIn. I post educational content on these topics. And I do that in text. I do that in video. I do that sometimes in documents. And that way you can learn across all the different categories I just showed you. That's what content I put out, not just tokenomics. Okay. And if you need help building out your tokenomics or auditing things, you can definitely book a call, free session with me today. And I'll just say that it has to be a good professional project with professional founders. So if I look at your website and it looks like clip art, I'm going to decline the call. Okay. I just want to meet with people who care about what they're building. They're professional with it. They have passion for it. And they have, I'm not expecting something magical because you're just starting out, but I do expect a level of professionalism and care that actually you care about what you're building. And that communicates to me that it's worth my time to get on call and talk to you about it, right? And that might even mean that you just have a white paper ready. You don't have a website. That's all cool too. But if the white paper is only 2 pages, I'm going to decline the call. It has to show that it's actually effort has been put behind the idea instead of just jumping on a free call for free consulting. It's not how this works. So you want to get my thoughts, my feedback, you have a professional project, you can book a call, we can talk about it, and I can probably help you pretty quickly identify some big flaws potentially in that and save you a lot of time and money. So anyway, that's sort of the presentation. Last 10 minutes, I'll take some questions from people.
Yeah, Tony, thank you so much. Now I have a feeling that we need another session with Tony about how to engage community, how to entertain token holders, and how to make anticipation of these speculative, feelings and so on and so forth.
Oh, you know what? That presentation is already done.
I would love to scale you on a better scale, sorry for tautology. And by the way, while founders here in Zoom are thinking over their questions to Tony, I want to remind people they were asking in YouTube, yes, the recording will be available on the same link on InMind YouTube channel. And all the links shared by Tony, we shared also in Telegram channel and in YouTube live stream. You can always ask additional questions in the comments. And by the way, if you find this workshop same insightful as I do, please don't forget to put like and share this video from YouTube with your followers in social media. We will appreciate it. Let's spread this knowledge. You know that there is not much good quality content on Web3 topics on YouTube and web at all. So we are doing this to bring this content to early stage and mature founders, help us to spread the word and share it with others. And right now I see hands. Let's start with power ecosystem. You start with your question, guys.
Hello, Tony. Thank you
for
a very good lesson. I want to ask a simple question about the liquidity. How do you think which amount of liquidity is required to listing my token of my project in DEX? I mean, this in simple, like a simple pair with my token and USDT. How you think which amount will be enough for have some deals on exchange for this?
Yeah.
In case that we have to sell tokens not by not only by exchange buyers, just for our community and users, they need to buy tokens, and we want to have a listing and give them ability to buy it from some exchanges, but we don't know which minimum amount of liquidity we need to put.
Okay.
Thank you.
Yeah, good question. So on the decentralized exchange, like a rule that I like to look at is usually at about 10%, right, of the allocation. That's what I like to see on sort of that DEX. But if your market cap is higher, then you might not want to put 10% in there, because then, like I explained before, it's hard to move. Like, let's say we have a $20 million fully diluted. and we have 10% of the supply in the DEX. Well, that means we have $2 million worth of value in the DEX. Well, if we go ahead and bring in buyers, well, then it's hard to move that price up because we've got $2 million we have to lift, right? And so in that case, you might want to make it more like $1 million, which would be 5%, because we still have $1 million worth of value backing our token, if that makes sense, right? So that's where it really becomes a little bit more technical versus a hard and fast rule. Then I don't want you to take 10%, grab the scissors and run down the hall, but do take that as sort of like a good rule for many projects I've seen. When I see something like 1%, that means it's going to be very volatile, okay? And the reason for that is also when people are buying the tokens from the DEX, that percentage actually goes down, right? Because the tokens that used to be there are going away. And so now you see it go from 1% down to 0.9%, down to 0.8, down to 0.1. And then you start seeing now we have real volatility come in, right? And that's where that becomes challenging. Now for centralized exchange listings, usually you'll find you need about $50,000 to $100,000 worth of tokens in value to actually list in the centralized exchange. You'll also have listing fees, depending on the exchange, of about $35,000 to $100,000 to $200,000, depending on the tier exchange you're on. And you should also budget between $3,000 to $5,000 per exchange for your market making activities per month. Okay, that's usually going to be your budgets for your market making. Okay, so when you're thinking about your liquidity on the centralized exchange, you look at how much tokens you have, and like I showed you in the template I put together, if you were to, let's say, have only 2% of your supply for centralized exchanges, and you look at the value of that, you look at the vesting, and you find that you don't even have tokens coming out that are even worth $10,000 for a year, that's going to be terrible. That's going to be terrible, and you might not be able to list. And so that's why that's an important component to that, is making sure that you have enough tokens to be able to use. All right. And if you book a call, we can actually look at all those things together on whatever your plans is, and I can help you advise on some things. Okay. So,
Perfect.
All right.
Oh,
Yeah.
thank you, Tony. Thank you, Tony. Very nice answer. We'll think a lot. I hope we will put recording, as Nelly told before. It would be great to have maybe another call if Nelly can connect us to maybe give us some advices how to do it, because we have not usual situation. We have a blockchain platform and our own tokens, which users using for deploy decentralized applications, and we're thinking just about a way to distribute our tokens to our target audiences.
Yeah, Max
Thank you
and
for the
other
time.
guys. So Tony agreed to provide a special link for startup founders from InMind, where you can book a meeting with Tony and ask him questions regarding your particular startup. So if you will have more questions that we will able to address today on a session, you can always book a call using this link. And all founders here in Zoom, we will also send it to you by email in your inbox. So don't worry if you missed any links, you will not be able to miss it.
I copied it carefully.
Perfect. Good job. Good job. Thor, I see your hand. You go next. Thor Peters.
One quick question, Tony, with your ears to the ground. I know fiat doesn't have intrinsic value. None of the tokens I know have intrinsic value. Do you know any tokens out there that has intrinsic value?
All the value is backed by that DEX, right? And that's what I'm trying to share with you is like, primarily it's backed by the decentralized exchange. Yes. Right. I mean, BUSD, didn't that used to be backed by Paxos Gold and stuff like some of this does, right? But anyway, so sorry, my wife was texting me about something. So I got to pay attention.
Pick up the milk.
Yeah, you got to do that stuff. You guys understand. So, anyway, yeah, there's a link. Yeah, I don't know of any that's like, I know there's projects that are backing by gold and things like that. And I know some very innovative projects that are spinning up that are trying to back through real world assets. Okay. I know that to be true. Okay. So I know that's definitely happening, but I don't have any examples yet. I think we will see that as time goes on. And that's really what we're going to see is, I do know one project called Lingo that is taking in like as part of their trading fees, and they're going to be buying like real estate assets. And those real estate assets that produce value will then be pumped back into the token price and buy that and spin that up. Okay. So that maybe is an example of like it's a unique model. We don't know, who knows whether or not that will be successful yet. Time will tell as it happens in the market. But their whole point was that if they had real assets that were actually generating cash, like what if Bitcoin had a trading fee and that trading fee was used to buy a real asset that produced cash? What would that do to the value, right? Like that is something that I think we might see kind of spin up in the future. But again, we're all building this together. We don't know what's going to work, what's not going to work, right? So that's sort of like what we're at. But yeah.
There were, when you mentioned it, there were some under Wyoming's Bill 38 that tried to do something like that a while ago.
Okay. Yeah, we'll have to see how these work out, because that would be amazing, wouldn't it? Like if all the Bitcoin trade, that's what the HM's, the gentleman that runs that project, was explaining to me. Is like, imagine if Bitcoin had a trading fee and those fees were used to buy up real estate and all these hotels and everything, and they produced revenue and value off that in ROI, and that bought it back. What would that do to the price, right? If that pumped back up.
Well, SEC probably shoot it down.
Yeah, I think it's, yeah, I agree. I see one other question here. Do launchpads provide liquidity as part of their value? Okay, so yeah, let me just say this is launchpads typically do not. That's the purpose of the launchpad themselves. Okay, so the purpose of the launchpad is really to enable you to have a way to raise capital. And the way they make their money, they work to make money. Okay, they'll take a share of the raise. They'll take a share of your actual token supply. And the thing you also want to look at with the launchpad, and I've tracked this back on chain, is when they take the share of the supply, do they sell it right away, or they sell it a little bit over time? Okay, so you'll find some of these, as soon as the project goes live, they dump it, and then that could actually kill your price, right? So that's something I actually looked at early on in my project before we launched it, is what launchpads are actually dumping the tokens, so that way when we were live, they didn't you didn't do all this work and then just use some software, right, and give them tokens and have them selling you. Okay. Let's say, can you program a smart contract to auto allocate a certain % of all token sales to liquidity pool? Okay, yes, you can. Okay, here's how this would work, is essentially, you see this sometimes in projects where they have a tax on buy and they have a tax on sell, okay? And you'll see a portion of that is allocated towards liquidity pool. Let me explain how that actually works, okay? When the token is actually being bought, let's say there's a 5% tax, okay? Now, Brittany buys 100 tokens. You're going to see 5 of those tokens will move to a smart contract. Okay, that's the tax. Okay, now once those tokens build up to a certain threshold that's set in the smart contract settings, okay, it will actually sell those tokens. Then what it will do, if it's building liquidity, is it will sell half the tokens and take that value, and it'll take the rest of the tokens, because remember, liquidity is 2 sides, and put that in the pool and deepen the pool. And so that's sort of one aspect that I actually used in my project. And what we're able to do is within 3 weeks, we're able to build our liquidity pool up to $30 million worth of value. Okay. Because what you're doing is all the transactions that happen, you're taking that liquidity and you're putting it back in the pool. And there's value in that, because as I mentioned, your starting point, let's say it's 10% at your market cap, and people are buying the token up, they're reducing that percentage down, and that's causing volatility later on, right? That's what's going to cause volatility later. So if you're able to keep that pool maintained, and let's say you can keep it at 10% through a tax, or maybe you have tokens already that you sell and you pair them manually, you have that in your plan, you can continue to deepen that pool and build that pool and keep it healthy. And the reason for that healthy pool is that's what the whales will look for. They will not buy into something that has 1% of liquidity in the pool, because that's volatility. When they put in their capital, the green candle comes way up and all the people sell off on them, and they don't want that, right? They want to invest, because here, if they're buying $25,000 worth of tokens, they don't want to have a big green candle. Why? Because they're buying up here. They're not buying here. They buy here when the swap happens, right? And that's the problem for it. That's lack of capital efficiency. But if they can buy and have a minimal increase, that's great for them, because they're getting as much tokens as possible for their money. And now if they believe in the project long-term, they just want to wait. That's how I work. I'll buy something and I'll wait 6 months, a year, and not even care about it. Okay. That's the name of the game. Okay. In my opinion, how you do it. So you buy it and you wait. That's what good whales tend to do. And that's what you have to enable for them. So hopefully that was helpful.
Yeah. And Brittany also asked, what's the best way to fund that liquidity pool? Any suggestions?
Yeah, like I mentioned, that's really that launch pad where you can raise that. and on the launch pad, and that will also enable you to be able to create a scenario where you're funding that through the public buyers and they're able to buy the token early, right? So doing that is beneficial. Now, if you have any concerns with the legalities around that, there are some firms that actually are liquidity providers that provide liquidity for that very reason, okay? So that's another way you can look at that too.
Perfect. There is also a question in the chat from Felipe. What's your view on projects launching on one blockchain and deploying tokens on another blockchain? For example, project is launching on Bitcoin and then launching tokens, deploying tokens on Ethereum blockchain.
Yeah, I would not do that. That ends up being a mess, because here's what you got to do is you got to think about this. You're launching on this blockchain here, and then now you're going to go ahead and migrate to another blockchain, right? Now, if you're talking multi-chain, and having your tokens live on two separate blockchains, that's beneficial. But if you're talking about raising here and moving everything over to this, that's going to be a problem, because people have all different wallets, they have all different software to go on. You have a huge transition and migration. But if you're talking about a project that's lived on Ethereum and now it wants to maybe be on, let's say, BSC or wherever, now what you'll have to do is you'll have to build a liquidity pool for those tokens to be traded. You'll also have to take a supply, okay, and have that also be generated so you can enable that as well. And I've seen some projects like double their supply when they do that. Some projects plan that in advance and have like an allocation of supply already set there on one blockchain that then will be considered essentially burned on this blockchain and used on the other one. So they maintain the set supply. And some of them you'll even see have bridges. The problem with bridges, as I'm sure a lot of you have seen, is they get hacked a lot, right? So whenever you introduce a bridge, you introduce a potential security hole, okay? So I do have to get running now because my wife needs something from me. So happy wife, happy life is what we say here in the States.
That is true. We will start the next workshop with this particular quote. Yeah. Tony, we respect your wife and your time a lot. Thanks a lot. And Kabalan, you can ask your question next time on a private call with Tony and all the guys here. Thanks a lot for your time. We will follow up with you shortly. Tony, you are the star. Thank you so much for this session.
Thanks for having me, guys. Thanks for listening to this. Appreciate you.
I hope today you changed the life of some projects, and on the next bull run we see less mistakes, less fails, and a lot more sustainability with tokenomics. Yeah, use the checklist, guys. You know, that's like every painful mistake I've made, I put in there. Okay, that's not just like because I'm a genius, it's because I screwed up a lot and I learned from those things. Okay, so that's what I just share with you. It's like that's why I built that, is like I share all that openly with you to help you out. Okay, because we're all learning and growing and building together. We want this to be successful, this space. So the more we share with each other, the more we try and help each other, and the more benefits we'll have. So if you need anything, you can always schedule a call. We'll talk through whatever with your project. Would love to. But anyway, hope you have a great rest of your day, and thanks for attending today. And we will do our best to learn on your mistakes and not obligatory on our own mistakes. Right, guys? Good plan. Thank you so much. Take care. Bye. Have a great afternoon, and thank you. You got it. Bye-bye. Bye.